What if one simple investing idea could outperform most professionals, beat the majority of active funds, and quietly build wealth for you while you sleep? John Bogle didn't just think it, he proved it. And the biggest shock? Most investors still ignore his advice. Today, we break down the core lessons from the little book of common sense investing, the blueprint for long-term financial success. The core idea: owning the entire market. John Bogle believed that most investors fail not because they're stupid, but because the system is designed to make investing harder, more emotional, and more expensive than it needs to be. His solution was radically simple. Instead of trying to pick winning stocks or predict market trends, just own the entire market. When you buy an index fund, like the S&P 500, you're effectively buying a tiny piece of 500 companies at once. You're not betting on any single winner. You're betting on the engine of American capitalism itself, which historically grows over time. Bogle argued that this approach captures the full return of the market with near zero effort, and more importantly, avoids the biggest trap: trying to beat the market. For beginners, this idea is liberating. You don't need expert-level knowledge, you don't need perfect timing, you don't need to read charts or forecast earnings. You simply participate in the long-term growth of businesses across the economy. This is the backbone of Bogle's philosophy. Invest in the whole market, hold it forever, and let compounding do the heavy lifting. The brutal reality: most investors underperform. Bogle highlighted a shocking truth. The average investor massively underperforms the market, not because the market is bad, but because human behavior is bad. Investors chase hot stocks, they panic during downturns, they buy high and sell low, they pay excessive fees for active funds that rarely beat the index. In fact, year after year, most active managers fail to outperform the market they're trying to beat. And even when a fund does outperform one year, it almost never continues in the following years. Bogle's message is blunt. The odds are stacked against you when you try to outsmart the market. Even professionals fail. The market return is generous enough if you actually capture it. The most damaging part? Fees and taxes quietly eat away your gains. A 1% annual fee sounds small, but over 40 years it can consume almost 1/3 of your total returns. Bogle called this the tyranny of compounding costs, and it's one of the primary reasons most investors fall short of their financial goals. Escape the high-fee system, and you instantly raise your long-term returns. The power of compounding. Bogle described compounding as a miracle that turns small, consistent investments into life-changing wealth. But compounding only works if you let time do the work. The more you switch investments, chase trends, or try to time the market, the more you interrupt the compounding process. Index funds are designed to maximize compounding by minimizing friction. They have low turnover, low fees, low taxes, consistent long-term growth. Imagine investing $500 a month in a simple S&P 500 index fund. At a 7% average annual return, you would accumulate over $600,000 in 30 years, even though you only contributed $180,000. That's the power of compounding working uninterrupted. The market doesn't grow in a straight line, but historically, patience is rewarded. Bogle's advice was clear. Choose an index fund, automate your investments, and leave it alone. The less you touch it, the faster your wealth grows. Bogle spent much of his life warning investors about the devastating impact of fees. Every dollar you pay to a fund manager, financial advisor, or trading platform is a dollar that can't compound for you. And because compounding works both ways, even small fees snowball into massive losses over decades. Here's the math. If the market delivers 7% annually, but you pay 2% in combined fees, your real return is 5%. Over 40 years, that difference can cut your final wealth by nearly half. This isn't an exaggeration, it's arithmetic. High fees are guaranteed, market outperformance is not. Index funds flip the script by offering ultra-low fees. Vanguard's flagship funds charge around 0.3%, so low that most investors barely notice. This cost advantage alone helps index investors outperform the majority of active investors. When you keep your costs low, the market works for you, not against you. The stock market is a giant distraction, Bogle often said. Headlines, predictions, and short-term noise tempt investors into emotional decisions. But Bogle argued that markets are volatile in the short run and predictable in the long run. The long-term trend has always been upward, fueled by corporate profits and economic growth. Staying the course means holding your index fund, even during recessions, crashes, and bear markets. History shows that the biggest stock market gains often follow the worst declines. If you panic and sell during downturns, you miss those recoveries and permanently damage your returns. Bogle's advice is simple but hard to follow. Trust the long-term trajectory of businesses, not the headlines. Don't let fear or greed derail decades of compounding. Bogle emphasized that the greatest challenge in investing isn't selecting the right fund, it's controlling your own emotions. Humans are wired to react impulsively, especially with money. We fear losses more than we value gains. We compare ourselves to others. We jump on trends when they're already too late. Behavioral mistakes lead to poor decisions like overtrading, market timing, or chasing winners. The solution is to build an investment plan so boring and automated that your emotions can't interfere. This means setting up automatic contributions, using diversified index funds, and ignoring short-term market movements. The investor who sticks to a simple, consistent plan outperforms the investor who is constantly trying to optimize. Bogle believed that complexity is the enemy of investor success. Wall Street thrives on complicated products, hedge funds, exotic ETFs, structured notes, because they can charge higher fees. But complicated products rarely outperform simple index funds over time. A minimalist portfolio of just 2 or 3 low-cost index funds is enough for most investors. For example, a total U.S. stock market index fund, a total international stock index fund, a total bond market index fund. This 3-fund portfolio is diversified, low-cost, and historically effective. Adding more funds doesn't necessarily improve performance. It often just increases overlap and confusion. Simplicity leads to consistency, and consistency leads to wealth. The role of bonds and asset allocation. While stocks deliver growth, bonds provide stability. Bogle recommended adjusting your balance of stocks and bonds based on your age, risk tolerance, and personal goals. A common guideline: as you get older, gradually shift more into bonds to reduce volatility. But regardless of allocation, the principle remains the same. Rely on index funds, diversify broadly, and avoid unnecessary trading. Your portfolio doesn't need constant tinkering. It needs time, discipline, and reasonable expectations. Asset allocation is your personal choice, but your investment philosophy should remain rooted in long-term simplicity. The ultimate lesson: stay the course. In the end, Bogle's philosophy boils down to a few timeless principles. Invest in broad market index funds. Keep your costs as low as possible. Avoid trying to beat the market. Stay invested through all conditions. Let compounding work for decades. Don't let emotions dictate decisions. Bogle democratized investing. He gave everyday people the tools to build wealth without needing insider knowledge, expensive advisors, or constant research. His message remains one of the most powerful in finance. The market is generous if you let it work for you.